would like to see the future of the thing. So it's what we call a review by the management. If you look at, if you go to a library or if you go to a place and look at the annual report, you will see a review by the management. The CEO statement, the chairman statement. It is not part of the financial statement, but it will explain the main features of the company, what they did, and why the revenue got dropped, why the profit got increased. And that is what the review is. So generally, the financial review will include the factors what influence the performance. It may be a country, a civil war. It may be weather. It may be the world prices of fuel. It may be the recession. Some things, certain things will influence the performance. It can be for good. It can be for bad. So the management must explain why the profit have increased, why the profit have reduced, and any factors that influence that profitability, that revenue, that cost, etc. And also about the way that the company has funded, the way they got the money, whether they got any new loans, whether they got any new share capital, whether the owner introduced new capital, all those things they will talk about it. And although it may not be very relevant for you all, but the risk management policies. Every company today, we need to have certain risk management. As you run a business, there are lots of risks, many risks. So that's your paper at the highest level, at the strategy level. But you need to know about the risk management policy. And the strengths and resources. So there are certain very unique strengths for your company. Maybe the branding. If you look at a supermarket in UK like Tesco, they have the branding, super branding. And maybe your strength is in your human resources. Maybe your strength is in marketing. Maybe your strength is in IT, that you have a good website open where the people can access, buy their goods. Look at the eBay, what they do. Their strength is in the IT. They sell millions and billions of dollar items through the website. So you will want to explain to the readers of the financial statements, the resources and all that. So it is not part of the financial statement, but it is something supplementary. So IAS encourages, it's not a must, but IAS encourage people, the owners, the managers, to give this kind of information. The purpose is to give as much as possible information for the people to make right decisions about the company. So whenever, Kimberly, we were talking about the audit, whenever the financial statements are prepared, the financial statements will be checked, tested by an independent party, and that is what we call audit. Auditors. So later on, I will discuss this in detail. The auditors will look at the financial statements prepared by the accountants, but the responsibilities with the directors or the managers. Okay, I'm trying very best. If there's any break-in, just let me know. I'll try to make it, but we have got the best internet, we have got everything, but there may be certain little breaks. If it's all, just let me know. I will again do these things separately. Okay. So the auditors, they will look at these financial statements and give their independent opinion. Let me know. Okay. So basically, the auditors will have to give an independent opinion about the financial statements. So they will check the statements and they will say whether the financial statements are prepared giving the true and fair way. That is the job of auditors. We are going to talk about a little bit about the fair presentation. Auditors are not there to prepare the financial statements. Auditors will have to just say whether the statement shows true and fair view. So for that purpose, the auditors will look at the statements and say that one. And for that purpose, the directors or the managers must prepare the statements in the true and fair way. So the financial statement should present fairly. Fairly, I mean, you can see the word fairly, not accurately. You need not be 100% accurate, but the statement should be fairly. It should be a fair representation. So you remember we were talking last time, we said the financial performance and the financial position, there can be little errors, but you can't have material errors. If you have material errors, the big mistakes or big misrepresentation, then that's not a fair statement. So remember, we are not looking for accurate financial statements. We are looking for fair financial statements. So that is what we should be looking all the time. Yeah. So basically, you have to recognize all the assets, and there are certain criteria, and this is what we discussed at the last time, the framework, the concepts. So there's a set of guidelines given to us in what we call conceptual framework, financial framework. So that's the guidelines that is given to us to prepare the financial statements. Yeah. So you have to comply with all the relevant IFRSs. What are IFRSs? They are the International Financial Reporting Standards. So every financial statement that is prepared must comply with the applicable IFRSs. So at your fundamental level, you don't need to know a lot of those IFRSs, but you need to know a little bit about it and also about the compliances. Then the second one, your accounting policies must be in accordance with the IAS. So that's the standard that deals with accounting policies. All your accounting policies must be held through the IAS. So that's the next one. Then your presentation should be, as I said, should be relevant, should be reliable, should be comparable, and should be understandable. So whenever we prepare the statements, you see, you remember last time we discussed these are the characteristics of the statement. Relevant, reliable, comparable, and understandable. That is what we call fair presentation. And the presentation should be always the presentation of additional disclosures whenever that is required. That must be provided so that the people will have a full understanding of the financial statement. So there's another relevant standard, but IFRS 12, the disclosures. In addition to all the financial statements, there are certain disclosures that what we have to make, and those things we will give it in this thing. So that's what we call a fair presentation. This is what will compile a fair presentation. And this is what the auditors will look at and say, yes, the company has prepared the financial statement. Yes, the business has prepared the financial statements fairly. Because when the auditor says that, that goes a long way because it's an independent review. Some other person is reviewing your financial statement and is giving a view about it. So you remember, whenever we prepare financial statements, we must comply with relevant international accounting standards, relevant international financial reporting standards. But, yeah? Okay. But there are certain departures, certain exceptions where you have permission to depart from the standards. Even though we are supposed to comply with the standards, there are certain exceptions. So I want you to note down this slide very earnestly, very carefully, because most of the time the examiner might ask you about the departures. So in rare circumstances, the management can decide that they will depart from the standard. They will not comply with the standard because they will say, there must be a reason, because they will say by complying with the standard is not going to present financial statements in a true and fair way. So because of that, they want to depart from the financial, depart from the normal standard. If that is the case, they must disclose it. Why they have departed? And because of the departure, why? Because they are not prepared according to the cash standards. What are the impacts on the financial position, the cash flow, etc. So you can't just depart and say that we are not following the standard for this reason. No, you must say we are not following the standard, particular standard for this reason, but because of that, the effects of the financial statement, our profit increase, our assets are reduced, or whatever, you have to show it. And you must say only one standard, only two standards I have not complied, but all the other relevant standards have been complied. So there are many, many standards. I think there are about 40 or 45 standards, and also there are about 15 international financial, more than that, I think 17 international financial reporting standards. So a company will have a big thing to do it, to comply with all the standards. If you are not compliant, you must say so and say why you are not compliant. And details of the departure from the particular IFRS, why it was necessary, and the financial impact of the departure. So, you remember we discussed something about the going concern and accrual. So, you remember we were discussing the 8 concepts. These two were considered assumptions. Whenever the financial statements are prepared, they were considered assumptions. But nowadays, accruals is not an assumption, but going concern is still an assumption. So, you remember we discussed this one. Going concern means basically your financial statements are prepared assuming that the business will continue for a foreseeable future. Generally, when you say foreseeable future, at least 1 year. So, if you are preparing financial statements for end of 2015, 2016 March, at least you must be almost sure the business will be in existence at least till 31st March 2017. If for some reason, if you think that the business is going to collapse, or you are going to wind up, or you are going to cease up the business, that fact must be told. And then we are not preparing on a going concern basis, we are preparing the business on liquidation basis. So that is number 1 about the going concern. The second one, what we discussed the other day, is all about the accruals. We spend cash, we receive money. But the financial statements are paid not on the basis of the money what we spend, not on the basis of the money that we have received, on the basis what we have earned and what we have spent or what we have incurred. So we may pay 1 year later, we may pay 2 months later, but that's an expenditure. We may receive the money for sales 2 months later, but that's an income. So we are preparing the statements on income and expenses, right? Yeah, so we have to prepare on that basis all the time. IAS 1 requirements, all the time financials should be presented annually. And normally it says within 6 months. So if your financial statements are ending, if your year is ending 31st March, at least by 30th September. But this is not very good. Now the requirement is, even though IAS 1 says 6 months, generally accepted standard is 2 months. In 2 months' time, you must prepare the financial statement. See why we call it timely information. Information must be timely. If you don't give timely information, information is totally not valuable. So because of that, at least annually, financial statements must be prepared. Every organization, big or small, they must prepare financial statements on annual basis. Some companies prepare every 6 months, every 3 months, no bar, it's good, but at least minimum annually it must be prepared. And the presentation should be consistent from one year to other year. So you can't prepare this year in one basis, next year 2 months. So yeah, 2 months from the time you say if the financial year is ending on 31/3/2016, your financial year is from 1/4/2015 to 31/3/2016. This is your 12 months. Normally, the account should be produced and given to the shareholders by 31/5/2016. Yes, one permits you to take 6 months. 6 months is too long a period. So today the modern practice must be given within 2 months. Anything over 2 months is not very good because earlier the things are very static. Between today and 6 months, the things are not going to change a lot. But today we live in a world where the things are changing so drastically. The environment is changing very fast. So waiting for 6 months financial to see your profit or loss is a too long a period. So therefore, now it is said within 2 months you must prepare the financial statement. Even though the IAS 1 provides 6 months. 6 months is the worst, I would say. The last resort. You must try and prepare the financial statements within 2 months. That's the best you can do it. And the financial statement should be consistent from one year to the other year. Don't change the basis. Don't change the policies. Don't change your way of estimating. If you are going to do that kind of thing, your financial statements are not meaningful because you can't compare. 1 year you are prepared in one basis, next year you are prepared it on another basis. You can't compare. That's not very good. So it must be prepared on a consistent basis. And if there are any changes, you can make changes to the base, you can make changes to the policies if you believe that the new change is going to be more appropriate. It's something more relevant. No, normally you can't change it. Normally you must maintain the consistency. I'm trying my very best because it's the best internet we have. It's the best connection I have. But I'm sorry if there's any break-in or echoing. What you will have is you will have the notes, you will have the slides, and if there's anything, just send me an email. I have already given you the email address. You can send it. I will make any clarification if there is anything because this is the best what I can think of in terms of voice as far as I'm concerned. Yeah. Sorry if there is anything because I think Sri Lanka, we are going through some little bit of problems at the moment. The weather is not very good here, so that may be one factor, but I'm not exactly sure why it is. But if it is so, you have to bear with me, and any clarification, just send me. I will try to clarify it for you. So what I was trying to tell you was that the financial statements must be. Thank you, Christy. Yeah. What I want to tell you is you can change. You are not supposed to change it, but you can change it if you think that the new presentation or the new policies are going to give a fair presentation. That is what the IAS 1 requirement is. Then the material items should be presented separately in the financial statement. So the material items. So your financial statements, I'm going to put a little bit of a slide for you just to refresh your memory about the financial statement. If you look at the statement of profit or loss, remember I told you it is statement of will, yeah, sure. Yes. I'm going to put the email here. Please note it down. And if there's anything that you need it, you can always um, write to me. I will surely come back to you. So it's Kumar55 gmail@gmail.com. So just note down anyone, or you can write to Anju, and Anju will pass it to me, and we will do that one. Thank you. Right. So yes. So IAS 1, I told you it's always called statement of profit or loss for the year end. If it is for a 1 year, if it is 6 months, you will say for the 6 months. It's always for the year end. I told you there's only one statement you prepare asset. It is the statement of financial position asset. Statement of profit or loss for the year ended. Statement of cash flow for the year ended. Statement of changes in equity for the year ended. There's only one statement what we prepare asset, that is the statement of financial position. So the normal standard format is uh, sometimes in our normal language we call sales, but the IAS 1 calls it revenue. So the terminology, please remember, very important. Revenue. This is the next one. The next big item is what we call cost of sales. So when you deduct from the revenue the cost of sales, we get what we call gross profit. This is the standard IAS 1 format that has been given to us, gross profit. From there, we deduct the establishment expenses. Establishment expenses. If the figures are material, we will deduct something called administration expenses. Then we have selling and distribution expenses. So when you deduct these things from the gross profit, so from the sales, you deduct the cost of sales, we arrive at the gross profit. From the gross profit, when you deduct all these, we get something called operating profit. Operating profit. And from there, we will deduct the finance charges, the interest what you have to pay. And now we don't call it interest, we call it finance charges. So I want you to note down this terminology because your examiner is very, very concerned about the terminology. If you say sales, he doesn't like it. If you say interest, he doesn't like it. You must say finance charges. So sometimes the examiner might put a small objective question. The same thing, one side interest, one side finance charges. The right one is finance charges. That's the terminology we use. Why? Because these financial statements are internationally transmitted. You are in another country, I'm in another country, I will see your financial statement. So everyone must understand when you say financial charges, is interest. Otherwise, people will use different languages to describe financial charges. People will talk revenue, people will talk sales, people will talk income, then you are confused. So you have a very, very standard terminology to use. And after finance charges, what we get is normally what we call profit before tax. If it's a limited liability company, we will have income tax. And after that, we will have profit after tax. So this is the format that is given to us. So you can see there are 1, 2, 3, 4, 5, 6, 7, 8. There are big lines. So you can't combine revenue and the cost of sales. No, you must show the revenue separately. You must show the cost of sales separately. You must show the gross profit separately. So there are material major items you will put up. And establishment expenses, you will have many things like rent, electricity, rates, can be heating, can be many expenses that is included. You don't need to separately show it in the financial statements. They are in your financial ledgers, they are in your books, but you group everything together and prepare the statement. So That's what we do. We group it together and prepare, and finally we arrive at profit after tax. What I was trying to explain, there are certain material items you can't ignore. You must provide it on the face of the financial statement. Others, little things you can do. So, financial statement should be and it should be consistent. You can change it where the new thing is going to be more appropriate. Material items should be presented separately. Revenue is a material item. Cost of sales is a material item. They are big items. If you try to hide those items, you're misleading the people. So because of that, you must give those things separately. Your establishment expenses are material. Your financial charges can be material. Show them separately. Don't group it together. And normally, what is called the asset and what is called the liability, assets are all what you own. So that is what we call assets. So later on I come to a definition for assets. But for the moment, asset is something what we own. What we own. Liabilities are what we owe to the others. This is what we owe to the others. So this is what we own and this is what we owe. So you can't set off. For example, you might give me, the company may borrow 100,000 from one of yours, and from the 100,000, I might buy a computer for 80,000. So I can't net it off and show 20,000 as my liability. No, that's wrong. I must show the 100,000 as a liability, 80,000 as an asset. That is what we should be doing. We can never offset except in very, very rare circumstances. But those things I'm not going to talk with you today. Later on, we will come across. Actually, you don't need it in the fundamental stage, the offset. So you should never offset. For your purposes, never offset the asset and a liability. Never offset the income and expenditure. So that's what I said. Your revenue and cost of sales must be shown separately. You can't deduct from revenue the cost of sales and show gross profit. That's wrong. You must show the revenue separately, cost of sales separately, and show the gross profit. And from gross profit, you will deduct establishment expenses, etc., etc. That's the way you must do the financial statement. And always we must do the comparative information. At least for the last year, we must give the comparative information. So the people will see this year's revenue, 2016 revenue, and 2015 revenue. People will see the cost of sales for last year, cost of sales for this year. So at least for 1 year, the comparative information must be given. That is for people to compare and to see whether your company is doing better or whether your company is doing badly. So that's what the IEA is one requirement, and these things we need to comply with it. Now I come to the second statement, the statement of financial position. So this is the statement that I told you, always prepare asset. Statement of financial position as at 31st March 2016. Statement of financial position as at 31st December 2015. This is the only statement we prepare on the basis of an asset. All the other three statements are for the year ended or for the period ended. We are going to look at what should be disclosed in the statement of financial position. So we have assets. So assets, we have two kinds of assets. I want to discuss that one with you a little bit. What are these two kinds of assets what we have? So generally, your money, the money that you get from the owners, the money what you get from the lenders, bankers, etc., all this money is invested in what we call non-current assets and what we call current assets. So earlier, the non-current assets were called fixed assets. Fixed assets. Current assets are always called the current assets. So this was called the fixed assets. But now the new term is non-current assets. So the company will need property. Company will need property. Company will need plant, machinery. Company will need equipment. These are what we call non-current assets. Why do we call it non-current assets? They are not meant to be sold in a short period. They are meant to be kept for a long period. So that is why it is called a non-current asset. Property, plant, equipment, that kind of assets are not meant to be disposed within 1 year. They are meant to be kept for 5 years, 10 years, 15 years, that kind of a thing. They are almost fixed assets in the business, fixed in the business. So earlier we called it fixed, but then the accountant bodies thought it's not right to call it fixed. The reason, it's not fixed. After some time you will dispose it. So, but you will keep it for more than 1 year, and for that one we call it a non-current asset. Then we have current assets. Current assets are essentially what will move from one day to the other day. Your inventory. Inventory means the goods what you have to sell. So today you have certain amount of goods, you sell that one, tomorrow you will buy new goods, day after tomorrow you will sell it. So you will always have some inventory. This is what is meant for, it is not meant to be kept for 1 year, it will be just moving all the time. So that is one current asset. The other one is receivables. Receivables is when you sell on credit. Now you sell me something on credit. I don't pay you today, but I will pay you in 2 months' time. So you are giving me 60 days credit. You are giving me 30 days credit. So that money, you are not going to get it today, but you will get it within 1 year. If it is going to be more than 1 year, it will come under non-current assets. But normally, receivables are something which you will get it within 30 days, 45 days, 60 days. That is a non-current asset. Sorry. Then the cash at bank, cash in hand, which is always moving. So you can see all these are moving assets. These, short term, they are non-moving. I'm using the word short term because in the long term, everything is moving. Short term, they are non-moving. So the statement of financial position should separately disclose these items. So, on assets, you must show property, plant, and equipment, which is called non-current assets. That is very important that you provide it as show it as non-current assets. Investment property. Now, some of the businesses, they might invest some money, not in a property, not in your own property, but say you might buy a property in India. That is an investment. Maybe you think that the prices will go up, and later on, not today, not tomorrow, not in 1 year's time, but later on you want to sell it. So you keep something for investment purposes. That's a non-current asset. Probably you are not using in the business, but you are invested as an investment purposes, where the value will go up. We put some money in the fixed deposit. It's something like an investment. So we are not going to withdraw it tomorrow, day after tomorrow. It will be there for a longer period. So that's what we call the non-current assets. Then for intangible assets. Any idea what is an intangible asset is? Now, you and I both will start two businesses, right? I have my property, plant, and equipment. I will have my investment property. You will also have property, plant, and equipment. You will also have investment property, maybe the same amount. But because you have been in business for a longer period, or otherwise because you are such a reputed company, you have a good branding, you have got a good image, that you can't value it, but that is surely intangible asset. So you can't value it, sorry, you can value it, but you can't touch it. It's not like property, it's not like plant, it's not like equipment. You don't see it, but there is something. So basically patents, copyrights, and names, these are what we call intangible assets. So they are in your balance sheet because there is some value for it, and that is what we call an intangible asset. So these are mostly all these will fall under non-current assets. Then we have the next step is what we call the financial assets. There can be certain money we are deposited in a bank, which is going to bring you some interest. You have no intention of withdrawing it for next 1 year, and that also will be a financial asset. Investment in associates companies, we don't need to worry about that one. That is where we invest a fair amount of money in one of our own sister companies. That's called an associate company. So that's the investment we will show it. Then we have some biological assets. Particularly in the medical profession, there are certain things, but they have done some research and all that. And even maybe in a forest company, there will be certain teak trees, certain wood, certain timber, forestry, all those things what we call a biological asset. So these things, so actually this time in one of the case studies, it's all about leisure park. So in a leisure park, the biological assets are the animals, the dolphins what they have, the lions what they have, the bears what they have. They are not property, they are not plant, they are not equipment, but they are biological assets. They have a value, right? Because those fellows are going to. Then we have the inventories, trade and other receivables, cash and cash equivalent. These three is what we call the current assets. So, examiner might give you certain assets and ask you to classify it under non-current assets and under current assets. So later on we will look at some questions, but the examiner might put up inventory and ask you whether it's a current asset or a non-current asset. It is a current asset. Property, it's a non-current asset. Plant, it is a non-current asset. So like that, you will have many things coming up. Then there's assets classified as held for sale that we don't need to worry. That is for discontinued operations. You don't need to worry about that one. Then we have in a company what is called equity. So equity is equivalent to the capital. So probably in your earlier studies you have come to what we call accounting equation. I'm sure many of you already have come across this definition, accounting equation. Accounting equation is today, let's assume that you are putting a capital of 100,000. So this is what we call opening capital. You are putting opening capital of 100,000. During the year, by putting this capital, you do a business and you earn 30,000. So that is your profit. Right? Now, earning a profit of 30,000, you remember I told you, business is a separate entity. Don't mix up your business money with your personal money. But out of this profit 30,000, you may withdraw 10,000 for your expenses. This is what we call drawing. The owner will take 10,000 for his own expenses, and finally this is what we call closing capital. So 100 plus 30 minus 10, 120,000 is what we call the closing capital. And this is what we call the accounting equation. So it is opening capital plus profit minus drawings is equivalent to the closing capital. So 100 plus 30 minus 10 is 120. What happens if you make a loss? Start a business 100,000, you end up with a loss of 20,000. So it's a minus. And maybe you have withdrawn another 10,000 for your expenses. Now you can say the capital has come down from 100 to 70. So this is what we call the accounting equation. Accounting equation is always opening capital plus profit minus drawing is what we call the closing capital. Now in a limited liability company, you can't draw money. Right? You can't draw money. Limited liability company is called a separate entity, separate legal entity. So So what they do is they will give you a dividend. So you have an opening share capital. The people have put opening share capital of 100,000, let's assume, and maybe the company has made a profit of 30,000, and maybe the directors will decide to pay a dividend of 10,000. It's not a drawing, it's a dividend. The directors have decided to pay 10,000, and this is what we call closing equity, closing share capital. This is the statement what we call statement of changes in equity. It explains from opening capital to the closing capital, the movement. So it is basically opening share capital plus profit minus dividends, drawings minus dividends is equal to closing share capital. That's what we call the equity. So that's the owner's capital. That is the owner's interest in the company. So basically the idea of business is owner's capital must go up with the profit. Otherwise, useless being in the business. If I give you 100,000 at the end of the year, if you are going to show me a owner's capital of 70, that is not a good business. I expect it to be at least 120 or 130. It must be opening, must be the closing must be more than opening. So under equity and liabilities, normally in a limited liability company, the equity must be shown separately and the liabilities must be shown separately. So there again, we have equity is basically the owner's capital in a company. That is money that the shareholders have put. Then we can take long-term loans. Earlier we called it long-term loans. Today we call it non-current liability. What is meant by non-current liabilities? You have no intention of paying these loans within next 1 year. Then we have something called current liabilities. Current liabilities are what you have to pay within next 12 months. So obviously trade and other payables. What you have to pay to the suppliers, you can't wait for 1 year. Most likely the suppliers will give you 15 days credit, 30 days credit you have to pay. So this is a current liability, trade and other payables. Then sometimes we have the taxes. We have to pay taxes when we make a profit. So tax payable, income tax payable. So that also you can't wait for 1 year. You have to pay it maybe within 6 months, and that is a current liability. Maybe you have not paid your interest yet on the loan, interest payable. So that is another current liability. Maybe accrued expenses. What do you mean by accrued expenses? Your electricity bill for the last month, your water bill for the last month. You remember I told you we account it on accrual basis. So we have accounted on accrual basis, but we have still not settled it. So that we will show it under accrual basis and we will show it under expenses. So that's basically what we will show. The minimum that we need to show is your equity, liabilities, then any provision. Provisions are a liability, but where we are not very sure about the amount. When we are not exactly sure, we make a provision. Now, if you buy goods from me, if I have invoiced you for 40,000, you know that you have to pay me 40,000, and that will be shown as trade payable. But sometimes it so happens we are not very sure what I have to pay. So maybe that you have a case and that you have to pay to the lawyers, but the lawyers have not yet billed. So you provide 10,000 as legal expenses. Not yet paid. We don't know, but we believe it is going to be as close as 10,000, and we create a provision. So where the amounts are not sure, we are not certain, the best estimate, we will provide it as a provision. You remember I discussed something called prudency. The prudency dictates whatever that we have to pay, later we must provide for it. We may not know the exact amount, but with the little information, we must make a provision. By making a provision, we are making ourselves very prudent. Otherwise, what happens is, suddenly when the lawyer sends a bill for 15,000, you are out of blows, right? Because you are not provided for that in your expenditure. So when you provide it for expenditure, that becomes a liability, and that's what we call a provision. So these are the things that we need to show minimum, and then of course the financial liabilities, as I said, the loans that you have taken, the bank overdraft what you have taken, all what you have to pay to the others are what we call liabilities. All what we own is what we call the assets. The assets minus liability is what we call the capital. In a company, assets minus liability is called the equity. That is what belongs to the owners. That is what belongs to the owners. After settling all the liabilities, whatever the balance is what we call the owners. The company is called capital. In a normal business, we call it capital or the owner's capital. So that's the way we will go to that one. As I said, the current tax liabilities and assets is always a current liability, so we have to provide it. Deferred tax is something like a tax liability, but we don't need to pay this year. Maybe we have to pay after 5 years later. That is called a non-current liability, and it is shown as deferred tax. So these items should be shown line by line with the figures. The minimum they must be shown. You can't ignore. You can't avoid. So the examiner might ask, put up few things and ask whether these things should be shown. Now, for example, in the income statement, I showed you the minimum that need to be shown. Revenue, cost of sales, establishment expenses, admin expenses, selling and distribution expenses, finance charges, tax, etc. So the examiner might put up something like electricity and ask whether we should show that separately. No, not necessary. Electricity can be grouped up with establishment expenses and show it. You don't need to show electricity separately. The trade and other payables will group up and show. You don't need to show that you have to pay Mr. John 10,000. No, you don't need to show it independently. John, Peter, James, all together, you have to pay 70,000. That will be shown as total. So you don't need to show separately. But 70,000 must be shown. You don't need to show separately 10, 10 and 50, but the 70,000 must be shown. That is what the minimum that must be shown. You can't get away from that one according to the IS1, according to the accounting standard. Liabilities included in the disposal under IFRS 5. You don't need to worry about IFRS 5, so I'm not going to deal with that one. Non-controlling interest, that also comes for consolidated accounts. That's not part of your fundamentals because you are only looking at the single entity, so I will not talk about that one. Share capital and reserves, yes, we have to show it separately because that is what we call equity. We will show it separately. Share capital disclosures. Now, in a company, we have the money we get from the shareholders is what we call share capital. So the shareholders will give the money, and that's what we call the share capital. Share capital is basically the money that belongs to the owner. In a sole proprietorship, there is no share capital, there is only capital. But in a company, we have a share capital. The shareholders will put that money and they get shares, and that's called share capital. So generally, share capital is what we call ordinary share capital, or sometimes we call it equity share capital. Equity share capital. So that's what we normally put it out. But sometimes the company might issue another kind of share, which is called preference share capital. Preference share capital. That is basically the ordinary share capital people are the powerful people. They are the real owners. But you might have another category of people. They will get their dividends in preference to the ordinary shareholders. The ordinary shareholders will be the last to get a dividend. So if a company makes a profit, first of all, you have to pay preference share capital dividend. So this is why they are called preferred share capital or preference share capital. They get preference. ordinary shareholders don't get preference because they are the ultimate owners of the company. So they will get all what is due inside the company at the end of the day. So the share capital disclosures when it comes up, the company law and the IAS 1 permit certain disclosures. So the IAS 1 says in the statement of financial position, you must say the number of shares authorized. Now, when a company is formed, company must decide how many shares they can issue. So the shares are normally at a nominal value, maybe $1, maybe £1, or whatever the currency, that's a nominal value. The company must decide the maximum they are prepared to issue, and that is what we call authorized share capital. The company might decide 100 billion is authorized share capital. In other words, the company has the power to issue 100 million shares. But the company may not issue entire 100 million today. The company may issue only 40 million. And that is what we call the issued share capital. So you have to remember, you have to pay dividends only on the issued share capital. Because you have got money only from the 40 million shareholders. Although you have the capacity, you have the right to go for 100 million, but you have not gone because you don't need money today. Because of that, you don't want to take unnecessary money and just keep it, so you have not gone for it. But you have the capacity to go up to 100 million. That is the difference between nominal share capital, the authorized share capital, and the issued share capital. So the par value is the nominal value. It is $1 or 1 sterling or whatever. So then generally what happens is when a company starts, they might issue 40 million shares today. And maybe during the year, they will issue another 10 million. So the opening share capital is 40 million. During the year, they issued another 10 million. And now the closing is 50. So you must do the movement. You must start from the beginning to the closing, how the share capital has got increased. Normally, share capital increases. Share capital cannot get reduced because you don't pay back the money back to the others normally in the share capital. So share capital never gets reduced. It will always increase with the new issues. So when you have preference shares, there will be certain rights, certain restrictions to that class of shareholders. Ordinary shareholders, they don't have any restrictions, neither they have any rights. But preference shares will have certain rights to get dividend in preference, in priority to the ordinary shareholders. So they will say 7% preference shares, that means they are entitled, they have the right to get the 7% dividend much more early than others. Then shares in the entity held by the entity itself are related. That is not necessary for you all because the group companies are not in the FFA. Then share options also not included for your syllabus, so you don't need to worry about that one. Right? So then I told you the current and non-current distinction. So whenever we say current assets, that means they are the assets that is they are for movement all the time. That is today it is there, tomorrow it will move and a new current asset will come. Today's inventory will go, tomorrow a new inventory. If you go to a supermarket, you will say they will have vegetables today, those vegetables will be sold today and tomorrow they will have new vegetables. And that's their inventory. Their fish will be sold today and tomorrow they will have new fish. But if you look at their racks and the shelves and the air conditioners and the buildings, they are not moving. They are there every day. And that's why we call it non-current asset. Till they decide to dispose it maybe after 5 years use when it is totally unusable, otherwise it will be there. So that distinction must be made very clearly, current assets, non-current assets. So whenever we prepare the statement of financial position, we have something called order of liquidity. So what is most difficult to convert into cash immediately is the property, plant and equipment. So that will appear at the very top. Maybe the next item, maybe your will come next item. Maybe your intangible assets. That will come new next item. When it comes to the current assets, out of the current assets, so difficult to convert it into cash is the inventory. So that will be there. Then the receivables. That is the most liquid asset, the most cash or the most liquid asset is cash. So you can see the liquidity goes up from bottom to top. The most liquid asset will appear at the bottom, and as you go up, you will find it takes more time to convert them into cash. So that's what we call current assets and non-current assets. Is very important, and in your case, you will be tested, putting up certain figures, certain items. They will ask whether it's current asset, whether it's a non-current asset. So, whether it's asset or a liability, whatever you intend to recover more than 12 months or whatever you intend to pay more than 12 months is called a non-current liability, a non-current asset. So, if you are going to receive my money after 18 months from the statement of financial position, that will be reflected as a non-current asset. But if I'm going to pay it in 60 days time from the day of the financial statement, it will be reflected as a current asset. So the criteria is to see whether it will get settled or collected within the next 12 months from the date of the financial statement year end. So if it is December, then next December will be the criteria. So sometimes the examiner might give you a question. Say in your financial year is ending 2016, and the customer is going to pay you on the August 2016. Whether this will be a current asset or a non-current asset. This is a current asset. Might say your financial ending year is 2016. You have taken a loan which you have to pay in 2020. So that means you don't have to pay anything in the next 12 months. This will be a non-current liability. So that's how you have to look at the figures, look at the situation, and decide what is a current asset, what is a non-current asset, what is a non-current liability, what is a current liability. So, statement of profit or loss, I have already discussed this one. As I said, we don't need to worry about the other comprehensive income at fundamental level. So, we start with revenue, then we have the cost of sales, then we have gross profit, then we have establishment expenses, then we have administration expenses, then we have selling and distribution expenses, then we arrive at what we call operating profit. So we arrive at first we call gross profit, then operating profit, then we charge finance charges, then we arrive at profit before tax, then we put the income tax in a company, and then finally we have profit after tax. This is your ultimate profit. From this profit only you can pay dividend. It's a company. But if it's an individual, you are normally the business is not taxed separately. It is taxed with a personal income tax. So this will be your profit, which we will take it to your capital statement. It all depends whether you are preparing company accounts, whether you are preparing individual accounts, whether you are preparing a partnership account. As we go on to the questions, we will see that one. So, allows income and expenditure to be presented either in a single statement of profit or loss and other comprehensive income, or what we call total comprehensive income. But we are worried only about the statement of profit or loss. So don't worry about other comprehensive income at your level. Later on, when you come to the P1 level, F1 level, we will discuss that. So that's the way So the minimum requirement for a statement of profit or loss, you have to disclose revenue, you must disclose the finance cost, you must discuss the share of the associate company. That is also not relevant for you all. That's not part of your syllabus, so don't worry about that one. Then pre-tax gain on discontinued operation, not necessary, that one. So basically at your level, you must put the tax expenditure, you must get the profit or loss, and then other comprehensive income not necessary for you all. So this is why I say these are not necessary, because these are coming up in the next syllabus. So don't worry too much about these syllabus. So total comprehensive income not necessary. Right. So statement of changes in equity, as I said, it explains the owner's capital from beginning to the end. So the owner's capital at the beginning of the year, as I said, maybe 100,000, and you have made a profit of 30,000, and you have drawn your personnel drawing 10,000. So this is a statement of changes in equity, the closing balance for an individual, capital at the end. So this is what we call the capital statement. We don't call it statement of changes in equity. Normally, when you call statement of changes in equity, it is for liability, limited liability company. So this also is very important. The examiner might put up certain figures of an individual and ask you whether it will go on the statement of changes in equity or whether it will come under the capital account. If it is an individual or a partnership, remember it is a capital account. But if it is a limited liability company, the same information will be reflected in the statement of changes in equity. So here it is opening equity, 100,000, profit, company profit 30,000. You don't do drawings, but the directors may pay a dividend 10,000. So this is called closing equity. This applies only for a limited liability company. So statement of changes in equity is only for a limited liability company. But the parallel statement for the individual is what we call the capital account. This is what we call that accounting equation. So most of the time your examiner is very focused on the accounting equation. So accounting equation, once again, capital at the beginning plus profit minus drawings is your closing capital. Always that is the accounting equation. So if the examiner gives you some example, capital at the beginning, I'm going to put up some figures here. So let's assume that the examiner tells you the capital at the beginning is 100,000. 100,000. He does not tell you the profit, so we do not know the profit. So let's put that X. He says, man withdrew 20,000. And he says the closing capital is 150,000. So this is what will give you information and ask you to calculate the profit. Opening capital is 100. The profit we do not know. That is what we expected. The drawings are 20,000 and the closing capital examiner says 150,000. So from here I can find my X. Arithmetic, 150,000 plus 20,000 minus 100,000 will be my profit. So I have made a profit of 70,000. So you can see it is right because I have 100,000. I have increased my profit 70,000 minus 20,000. My closing figure is 150. So examiner might put up like this blank. He might give you the profit. He might give you the opening capital. He might ask to give the closing capital and ask you to work out the drawing. And he might give you the first figure and ask you for the closing capital. So remember this formula all that time, very relevant, and you can score a lot of marks because I told you there are 50 questions, 120 minutes, but certain questions you can do it in 1 second if you know the formula. So some formulas you will memorize it and go to the exam and you can use it. So we will look at some questions later on when I'm doing the questions. But I encourage is I know you all have done a lot of work in this area. I'm only trying to refresh and I'm only trying to put some new thinking into you with the latest thinking. But what I always say, don't wait for me. Take your exam. Sorry. Yeah, what was the formula? Opening capital plus profit minus drawings is equal to closing capital. Okay. Opening capital plus profit minus drawings. Thank you. Right. Closing capital. So, what I'm trying to tell you was, don't wait for my question. Go and open up questions and try to look at the questions and do lot of questions. And if you come across any question that you are struggling, just send me a mail. I will answer your question. But I will also do with questions with you all. But don't wait everything for the lecturer, because it's your exam. You must put lot of effort. Try and do many questions. The more questions you do, more easy the paper will be for you. So if you have Kaplan, go to the Kaplan. If you have BPP, go to the BPP. If you have a website, go to the website. Look at lot of questions, and you will come across some difficult questions. Give me the question. I will discuss with you all, and even sometimes it may be good to share with the entire class. So that way we can share our knowledge. We can do better things. So basically, statement of changes in equity presents movement from the opening capital to the closing capital. So whenever there's a profit, it will increase the capital. Whenever there's a loss, it will reduce the capital. Whenever there's a dividend or drawing, it will reduce. Finally, coming to the notes to the financial statements. Your financial statements, I told you there are 4 statements. Statement of financial position, statement of profit or loss, statement of interest in equity, statement of cash flow, and finally we have the notes. So when it comes to the notes are very relevant, and the notes must give a detailed analysis. So for example, you might have a revenue figure, $200,000, $250,000. You may want to give the breakdown of this revenue. Now that will not give on the face of the profit or loss. As a note, you can give the turnover, the revenue detail. So as I said, in common terminology, we use sales. Sometimes we call it turnover. But the right terminology for the examiner is revenue. So revenue 250,000, it can be split into the geographical areas. If you are a multinational company, you may want to say UK revenue is 100,000, USA revenue is 50,000, Europe revenue is 75,000 or 25,000, and Far East revenue is 75. You give the breakdown. Sometimes you may want to give the revenue breakdown in terms of products. Right? Hardware sales revenue is 125,000. Electrical product sales revenue is 90,000. Grocery sales product is 35,000. You can do the breakdown. That information is provided as note to the financial statement. So examiner might put up a question and ask you whether this should be shown in the face of the financial statement or whether it should be shown as a note to the financial statement. The right answer is a note. Any breakdown of revenue, any breakdowns of information should be given as notes to the financial statement. Because your financial statement should be one page, neat and nice. Any person who wants to go through will be able to understand that one without too much of difficulty. But if you need more details, go into the details later on. That is what the notes provide. So sometimes the people will look at the front sheet and they will be quite happy. But one person may want to go into the notes and to say 250,000, yes, where did it come from? What were the sales? How much did the UK bring? How much did USA bring? Cost of sales, they may want to see. Finally, they want to see the gross profit. Who has made the biggest gross profit contribution? Is it USA or is it UK? Something like that. So that's relevant information and that will be given. So generally the note should perform the following function. So I want you to note down this one. Because your examiner might ask, what is the function of notes? After giving all those 4 statements, why should you have a 5th statement with all these notes? Real detailed word. So basically the purpose of the notes or the functions of the notes is to give the specific accounting policies which the company has used, which the business has used, and the basis on which the financial statements are prepared. So the main purpose is to give the basis and to give the accounting policies that were chosen to prepare the financial statement. Because there is a little bit of a freedom for us to decide on certain policies and certain bases. So there can be a little bit of variation between your statements and my statements. So for comparative purposes, you must tell what are the accounting policies you have adopted. So depreciation, I have adopted that building should be depreciated over 20 years. I have adopted the policy whenever I have some, I think Anju will be doing this one on Tuesday, receivables that we have we provide for bad debts or what we call allowance for bad debts, 5% of outstanding debts. So we tell the people these are the policies that we have adopted. We have valued the inventory on first in, first out. We have valued the inventory on average basis. So the people will know because there are certain freedom given for us to choose certain policies. Some no freedom, but there are certain freedom. Estimates, always there's a freedom. Now, you buy asset at 100,000. Let's assume it's a plant. We also buy the same plant, 100,000. I think it will have a life period of 10 years. Who thinks life period is going to be 5 years? Who is right? Who is wrong? Both are right. Because who can challenge my 10 years? Who can challenge your 5 years? But because you have been on a 5-year basis, you will provide depreciation per year, 100,000 divided by 5, 20,000. The other, me, will provide 100,000 divided by 10, 10,000. Both are right. No one can say that, no, I have overestimated. Unless I have totally exaggerated and estimated. I have taken 100 years or something like that. 10 and 5, no one can challenge it. So therefore, these estimates must be told. I must tell, I have estimated the life period to be 10 years. You must tell, you have estimated the life period to be 5 years. So anyone comparing will know how. Kumar has provided only 10,000, whereas John has provided 20,000. So they know to do the adjustments for the comparison. That is the purpose of the note. So the note becomes very relevant, very important from the people. And disclose any information not shown elsewhere in the financial statement which is required by IFRS. So I'm not going to go into a lot of details of this one, but for one example is the director's interest. The directors may have taken a loan from the company, or directors would have given a loan to the company, or directors may have taken certain goods at a discount rate from the company. Now, that is not shown in your revenue, that is not shown in your cost of sales, even in your receivables, that will be included and shown as one figure. But IFRS 12 says any transactions done with closely related parties should be disclosed separately. So whenever we see that kind of a situation, the notes will provide information saying Kumar, who is a director of the company, bought goods from the company. Normal selling price is 10,000, but for the director it was given at 8,000. Of course, remember the materiality. If the transactions like 1 million in the 100 million, don't disclose 10,000 and 8,000 is ugly. But if the company is dealing with 100,000 turnover, 10,000 is big. In that case, you must say that to Kumar, the director of the company, you sold the goods at a lesser rate than the market. Or trade receivables includes the receivables of the company is 30,000. It includes receivable amount from Kumar of 15,000. That is material. But Kumar owes $5. Don't put that as a note because that's not material. That's not going to change the decision makers' view about the 30,000 and $5. But if we know out of the 30,000, Kumar owes 50,000, that will raise a question. Is this sale a genuine sale? Why does he owe 15,000? All sorts of questions can come up. So the materiality always will take precedence whenever we show it as notes or whenever we make disclosure. That's very important that we know that one and we should do it. So any additional information, whatever is needed, relevant to understanding should be provided. Whatever that is additional, what you think, there is no law here, there is no rules here. You must think what is relevant for these people. Is this relevant? For example, maybe you prepare the financial statements as at 31st March 2016. And today we are in somewhere in the 20th of May 2016. And you are preparing the financial statement. Between this day and today, 31st March, it was there, but by this time, a flood has come, and a building has got damaged, and that building which appeared in the balance sheet is now a write-off. That will not appear in your financial statement, because the financial statements as at 31st March 2016, the building will appear at 20,000. The profit. Now, during the 31st month and 20th May, we know that it is no longer there. Now, you can't go and put in the financial statement. What you will do is, you will put a note. You will put a note. You will disclose it. The building what was in existence on 31st March 2016 got damaged by flood, and that building is a write-off. For example, under trade receivables, you would have shown on the 31st March 2016 amount due of 100,000, which included receivable from John of 10,000. And now you see, 20th of May, you know, John is dead and you can't recover the money. So we must disclose that. Put 100,000 there, but we will now tell there's a 10,000 due, but he is no longer living and therefore it needs to be written on. So significant information, whatever that is not reflected in the financial statement, should be disclosed by way of note. So the IAS order for note, there's a certain order. So that is just to compare, because the revenue comes number one. So anything you will number the notes. So revenue, for example, you put revenue as 250,000. You will say note number one. And in the note number one, it will give the details of revenue. So any person who is looking at 250,000 revenue, from where did I get? I just have to go to note number one and see revenue. Yes, UK 100,000, USA 50,000, something, it will give. So that's what we call the statement of certain order that you have to comply all the time we have given. All significant accounting policies must be disclosed. All supporting information must be told. And any contingent liabilities. So this is something which I will discuss later, but as we are in the subject, let's talk about it. What is a contingent liability? So what is a liability first of all? Liability is a present obligation. Something which you have to pay today. Not that you are going to pay today, but you have obligation to pay maybe after 30 days, but it's a present obligation. That's what we call a liability. A contingent liability, you don't have a liability today, but it may come later. For example, you have a case in the courthouse, and today, so far, the judge has not declared anything against you, but judge may declare and say you have to pay 15,000 to the government for damage in the environment. Now that's a contingent liability. We don't know, but it may arise. Now this happens mostly in the individuals. Sometimes I may, because you are my friend, I might go and sign you. You are going to take a loan. I will sign as a guarantor. So when I sign as a guarantor, there is no liability as far as since you are paying the loan, no liability on me. But the moment you stop paying, the banker will give me a call and say, Kumar, Peter has not paid, now you have to pay. Now that's a contingent liability. Still not a liability, but it can become a liability when a certain event occurs. That is what we call a contingent liability. Contingent liabilities, it is not in your statement of financial position. Remember, it will be always a note. This is another one I want you to note down. In your examiner, we might say contingent liabilities, where will it appear? It will not appear in the statement of financial position. It will not appear in the statement of profit or loss, but it will appear as a note to the financial statement. So you have to be very sharp. You need to know. I will be sending these slides. I think already it is in the Dropbox. But if anyone wants, a couple of people who requested the slides, I will send it to you all. If any of you all have not got it, please ask me. I will do it. I think these things I have already put it in the Dropbox. But if you want anything, just send me. But these notes are, these slides are, I think, very important for your exam. So, other disclosures also must disclose in the notes the dividend proposed or declared. So, dividends, the directors will propose at the annual general meeting, the shareholders will approve it. Directors only can recommend, but the approval must come from the shareholders. But the shareholders can't ask the directors to increase the dividend. Shareholders can't demand a dividend. Even though they are owners, they can't demand a dividend. But when the directors come out with a recommendation, they can approve it. The moment it is approved, it is considered a declared dividend. Till it is approved, it is a proposed dividend. This is also another very important one. The examiner might say the company directors have decided to pay a dividend of 20 cents per share for the year ended 31st March 2016, and directors have approved it. But directors' approval does not mean that it is a declaration. So when the directors approve, it is only a proposed dividend. You must disclose it, but it's a proposed dividend. But when the shareholders approve this dividend, it becomes a declared dividend. So that is what you have to be always mindful whenever we come to the other disclosures. Any preference dividend not recognized. Remember, as I told you, the preference people are the people who get priority for dividends. So, ordinary shareholders have no right for the dividend. But the preference shareholders have a right for dividends provided the company make a profit. So, maybe in 2015, the company has not made a profit. It's a loss of 50 million. Then the preference shares are not entitled for any dividend. So, they have to get a 7% dividend, but 2015 no profit. 2016, company makes a profit of 50 million. Now, if the shares are defined as cumulative preference shares, you have to pay with arrears. 7% which you did not pay in the 2015 and 7% of 2016, you must pay 14%. That is, provided the preference dividends are cumulative. If it is non-cumulative, then you don't pay in 2015. Forget about 2015. 2016, you pay only 7%. So that is what we call non-cumulative. Cumulative means you must pay with the arrears. If you are not paid for 2 years, third year, you have to pay 21%. But non-cumulative means you don't pay in the first 2 years, third year, you pay the 7%. That's all. You don't need to worry about it. Right? So these are the information that we have to do it. Then I spoke about the accounting policies. Accounting policies basically the measurement. What is the way that you have measured? You remember I discussed some measurements the other day, the values. Historical cost, replacement cost, uh, value in use. There are many methods of valuation. Inventory can be valued in many methods. The relevant accounting standard is IS2. It provides there are two methods of valuation. One we call the average method. Other one we call first in first out, which we call first in first out FIFO. Right? FIFO. I'm just going on the assumption that you all are clear. If you all are not clear, you have to quickly tap on me. Otherwise, I'm going because I want to cover up the syllabus. But my intention is not just to cover up the syllabus, but for you all to get the knowledge. Because this is all what we are learning is not only for this exam. This is needed right through, right to the end, till the exams are over, and even after that. So the inventory can be measured in two ways. Later on we will learn, but you have to say the measurement basis. What is the way the inventory is measured? What is the way the non-current assets are measured? Is it the revaluation or the historical cost? Then the other accounting policies, like the depreciation policy. So you have to mention the depreciation policy. So with that, I come to the end of this second part of my syllabus. What I did was basically the financial information presentation. Yeah. Before I move into the next one, any questions you have? Once again, I will share these slides. Already it is there in the Dropbox. But anyone who wants the slides for your personal use, just send me a mail. The slides will be available for you. Okay. So, I have a little bit another 10-15 minutes over. So, because of that, I'm going to look at another particular area, which we call the accountancy terminology. So, in our accounting, we have a little bit of terminology what we use, which is very, very important for all of us. Whenever the examiner puts up a question, we must know the terminology very well. So, basically, if you look at the accounting, what is accounting? Accounting is basically, in a business, we have lots of transactions happening. What are the transactions? We do sales. What are the transactions? We buy items. What are the transactions? We manufacture items. What are the transactions? We pay the electricity bill. What are the transactions? We have to pay the water bill. What are the transactions? We have to buy property. What are the transactions? We have to buy a vehicle. So there are many transactions happening in a business, and every transaction must get recorded. So that is what we call the accounting system. Accounting system records every little transaction. You pay $5 to the garbage cleaner, that also will get accounted in the accounting books. You pay 1 million as a loan to some person, that will get accounted. You pay salaries 50,000, that will get accounted and recorded. So every transaction, financial transaction, will get recorded, and that is what we call an accounting system. And everything what is recorded is summarized, and ultimately those summary information is used to prepare your financial position and your financial performance. On a particular given date, yeah? On a particular given day or for a particular period of time. And that information is very crucial to the stakeholder, and the basis for that information is your accounting record. So you maintain your accounting records, recording every transaction, big or small, every transaction is recorded. And all that recorded transaction is what we call information. That information is finally summarized And that is what we give it to the stakeholders as financial statement. So I'm using the word stakeholders. Stakeholders are the people who have interest in the company. Owners, lenders, government, employees, the directors, customers, suppliers, so many people are interested in your company, they are called the stakeholders. So the stakeholders, they will use that information to make significant economic decisions. For example, the shareholders will use this information to see whether the company is doing good or bad. If the company is doing bad, they might want to get out of that share. They don't want to keep on, they will want to sell the shares. The employees will want to know whether the company is going on the right direction or not. If you, as a young CIMA accountant, if you join a company and if you know that company is not doing very well, you don't want to stay there that long, you want to leave the company. Customers, when they buy a product, they want to know whether this company will be able to give the aftercare service. If you buy a TV, for example, you want to see whether that company is solid, whether that company is making profit, whether that company will stay for a foreseeable future, so that you know your TV will get maintained, repaired. The bankers, before they give a loan, they want to know whether the company will exist for another 1 year, 2 years, 3 years. So they will analyze those financial statements. From there only they will know whether the company is a growing company, whether the company is a loss-making company. It can be a company, it can be a business. I'm talking in very general terms. It can be a sole trader business, but still for all, we need to know that one. Then the stakeholders will have good quality information. So they must have very good quality information. That is why we said the information should be relevant, information should be timely, information should be understanding, information should be comparable. So that information is needed for them to make quality good decisions, which is what we are supposed to do it, and that is what we should be doing it all the time. So that's what we will be looking all the time as far as information is concerned. Yeah. So financial accounting. Now I want to talk about two things: financial accounting and management accounting. So financial accounting, there are two types of accounting. Actually, CIMA, originally, long time back, they were called cost and works accountant. CIMA was originally known as cost and works accountant in somewhere in 1970s. Later on, they became cost and management accountant. So they were mostly focused on management accounting. Later on, they became Chartered Institute of Management Accountant. So the CIMA has changed from one period to the other. Their name, not only the name, with that the emphasis. Now they talk about the Chartered Institute of Management Accountant. So you are basically management accountant, but that does not mean we can get away without doing the financial accounting. So financial accounting is simply concerned with the production of financial statements for external users. Management accounting, on the other hand, is concerned with giving information to the internal users. Who are the internal users? The managers themselves. The managers want to know how many units did we produce yesterday, how many units did we produce last week, how many units did we produce today, what was the cost per unit last week, what was the cost per unit last year, what is the cost per unit today. All that is information the management requires to manage the company. But financial information is required mostly by the external people, the people who have given money to the company, the people who have some interest in the company, the government, to see whether they're making profit and they are paying right taxes. So for that purpose, we provide financial statements. So generally, the financial statements, as I said, it reflects the stewardship of funds entrusted to them by the shareholders. So at the end of the day, you will see the financial statements and see whether the directors have been good or whether the directors have been bad. I don't know whether how many people of you all can remember that some time back we had in 1990s the company Enron collapsing. And what we found was the directors were cheating. Even today, we find some companies, the directors are cheating. That can happen. But the stewardship of the directors to the shareholders are the owners, it is reflected through the financial statement. So investors should be able to choose by reading those financial statements, they can decide where to invest, where to divest. Good companies, they will want to invest. Bad companies, they want to get out of it as quickly as possible. And to facilitate that kind of a thing, you must give the comparison. So you must always give the comparison. And for the comparisons to be uniform, they must be prepared using what we call accepted accounting conventions and standards. And this is why we have so many standards: international accounting standards, international financial reporting standards, and then we have generally accepted accounting principles. So there are many guidelines for all of us, for you, for me, whenever we prepare financial statements. In a way, it's good. No one can just go in their own way and prepare. We are guided by the international accounting standards. We are guided by the international financial reporting standards. We are guided by the generally accepted accounting principles, and we are guided by the framework of accounting. So these guidelines are available for us all the time for us to prepare the finance. And because we are preparing, whether you are in Dubai, whether you are in USA, whether I'm in Sri Lanka or another person in UK, since we apply this international standard, our financial statements, wherever it is prepared, it will be somewhat similar. So always start with the revenue. Not one will say sales, one will say turnover, one will say, net profits, one will say something. No. Everyone will prepare the same way. Everyone will have the same standard format. So the comparison becomes much more easy. The financial statements are public documents. They are basically the public documents, and therefore they will not reveal details about the company's internal information. For example, they will not talk about the product profitability, because that's not the company's information. That's inside information. What is given is a public document. So you are not going to disclose all your the company secrets in your financial statement. But those secrets, the cost, for example, all those things will be appearing in a management accounting. So next Tuesday, I think the next lesson is on next Tuesday. Next Tuesday, I think Anju is doing the lesson, and after that on Wednesday I will be back, and I will start it from there. So once again, any questions, you have to just send me a mail, whatever, okay. I will ask Anju to send the Dropbox, but for the moment, if you need your slides, just send me a mail. I have given you in my chat box the email. I will send you the slides for the moment. And anyone who has any questions, just please write the questions and send it to me. I will encourage all of you all to look at questions in your free time. And later on, I will do a question time session. But once I do about 1 or 2 lessons, I will have a fair knowledge. You all will have a fair knowledge to attend the question. We will do it. And thanks for today. If you have any ideas, any questions, just put it on the chat box quickly. We can address it. But I'll continue from here in my next lesson when I take it from you. Any questions you have? Anything? All right. Could you avoid using the pointer pen? Your voice cracks when you do so. making it hard to follow. Okay, right. Okay, we'll see. I thought the pointer pen will be useful. We'll try that one. Okay, thank you. Right. Yeah. Any other things that you have? Okay. Thanks a lot. Whatever you have, please send me. Just send it to me. I will answer any question that you all have. So thank you very much. I will see you on Wednesday, but Anju will do the next FFA on Tuesday, same time, 7:15. Okay, thank you very much. Take care. Good night. Bye.